Hello friends, clients, and fellow financial advisors. My name is Ron Bullis and I am the CEO and founder of Lifeworks Advisors. My guest on today's show is the CEO and co-founder of one of the fastest and most innovative RIAs in the wealth management industry. To date, he's raised over $58 million of venture capital for his firm, and he's challenging the traditional asset-based fee model in our industry. His story is unique and compelling, and his personal mission for transforming the wealth management industry is contagious. I have been looking forward to this conversation for a long time. Welcome to the Future of Advice, Andrews Jones.
Great to be here. Thanks for having me.
I have been following your firm now from the sidelines for a few years. Very excited to have this conversation. We were introduced by a mutual acquaintance that said the two of us should connect because we're both trying to challenge some of the status quos in the industry and have some similar viewpoints on things like clients' best interests, the fiduciary rule, business models, things like that. So I've got a ton of questions for you.
Yeah.
But let's start with something right off your bio on your website. You list two reasons for kind of the connection back to the wealth management industry.
Sure.
And you came from technology, VC, investor to wealth management, which is maybe there's not a normal path, but you kind of took an interesting road to get there. But you list something that I want to just maybe start us out with. Actually, you know what? Let's do this. Let's back up a second. For those that don't know about Facet Wealth and what you guys are doing, just give an overview of the firm, when you started, how many employees, where you guys are at.
Yeah, so at Facet, we are basically building financial planning the way that it should be. We see this enormous hole in the industry where you've got about 38 million households that have more nuance and complexity in their financial life than what a DIY digital solution like a robo-advisor can really help with, but they don't have the asset base that's interesting to traditional advisors. So these 38 million households, they represent like $44 trillion of assets. So it's not that they don't have money, but about 40 trillion of that is either in primary residential real estate or some sort of retirement account that a traditional advisor can't fee on.
So like it's tied up in their 401k or 403b or something.
Exactly. Yep. And so these people have financial planning needs, right? And when we talk about financial planning, we're not talking about, here's a 200-page e-money plan. By the way, the answer is a 7% commission annuity, right? We're talking about things like cash flow, what's coming in every month, what's going out. Starting a family, how should I think about saving for my kids' college when they're not even born yet? How do I think about paying for remodeling the guest room and turning it into a nursery? I mean, we have this tagline, which is that every decision is a financial decision in your life. And so we really view that financial planning needs to take into account every aspect of someone's life. We don't charge an asset-based fee. We charge a flat annual subscription that's tied to the services we're providing. So it really is this is what you're paying for and this is what you're getting, and we can draw a very clear line to the value that you're receiving for the money that you're paying us. We're totally virtual, so I know we'll get into that in a little bit, but the company is in, I think we have employees in 42 different states. We have about 300 people on the team right now.
So your payroll department loves you.
Yeah, exactly. Pretty sure we outsource that. But yeah, so we have people in 40 different states. We have clients in all 50 states. And yeah, I mean, we just see this enormous opportunity of folks that need the help, but there are no good solutions in the industry, or minimally good solutions for them. Yeah,
I mean, I couldn't agree with you more. I think that there's, I've seen it over the 14 years I've been in the industry, right? That either advisors they've been coached to have a minimum asset size, right, or a minimum account size. And what happens is you find these people that have money tied up in a 401k or a 403b, and because it's not billable, they sell them some insurance or a crappy annuity product and move on.
Yep. 100%.
And that's the way it is. So, your co-founders of Facet you guys all share some interesting stories about family connections to the industry.
Yeah.
Let's go back, because I found it really interesting that you're talking about continuing your mom's legacy. So your mom was involved in the 401k space. Tell us a little bit more about.
Yeah. So first of all, I'll say, we're all born with, with certain advantages, and my number one was the mother that I have. She's been an amazing influence in my life, and we're very close. Which is awesome. She was at Fidelity for most of her career. Okay. Spent, I think, about 20 years there and worked on the team that built their whole 401k business into what it is today. And so when she talks about her legacy in financial services, one of the things that she's the proudest of is that she's helped millions of Americans save for retirement. And so when I think about what we're doing at Facet is, our goal is to help millions of Americans have a better financial life in general. And so I think it's a really nice continuation of the work that she's done, and just sort of as the industry has evolved and takes into account more and more what people actually need and how to help them live a better life and putting the customer first. I see that as a really nice way for me to kind of be in the family business, so to speak.
Yeah, that's awesome. I think that it's easy for those of us in the industry sometimes to lose connection to the fact that the ripple effect of what we're doing over a long career is touching thousands, tens of thousands, in your mom's case, millions of people.
Yeah.
Your work. That's awesome.
One of the things that we, I think, has allowed us to build the culture that we have internally, and one of the reasons why we're able to have a 300-person totally virtual workforce is that everyone is really tied into the mission. And we actually have a Slack channel that's called Dreams Made Possible. So our internal communications tool, right? It's this channel is called Dreams Made Possible, which is every time one of our advisors helps one of their clients hit a goal, they post about it so the whole company can see. And we get like 3 or 4 of those a day. And it's starting a family. We have pictures of kids that have been born that show up all the time. We have here's the first house that someone got to buy. There's all sorts of, and the goals are sometimes we have people who ask us about how can I save to go on a 2-week beach vacation with my family, and then they send us a picture of the whole family at the beach. These are I think the real, this is the real goodness in financial planning, and this is where we actually are in a noble profession. If we do it the right way.
Yeah, I love the word noble. My business coach used that word years ago when I first met him. And it's framed everything we've done at Lifeworks too, right? Getting to have the blessing of tagging along with our clients through both the ups and downs and watching them turn their money, their life's work into the things that matter most.
Yeah.
Right. It's an amazing profession to get paid to do that.
Yeah.
Right. So each of your co-founders has an interesting story. I read them. The corollary, right, is that it connects back to they had a family member or a loved one that was maybe being sold a product. I want to read something off of your bio, and then we're going to dig right into something that shouldn't be controversial in our industry, but it still is.
Yeah.
So here's a quick quote from your bio. In 2015, the U.S. Department of Labor proposed the fiduciary rule, which would have required financial advisors to act in the best interests of their clients. The pushback from the industry was fierce. If this rule was passed, the industry said, 8 million households would lose their advisor relationship because their advisor could not afford to both service them and act in their best interest at the same time. And this is the line I love. This was the industry basically admitting that its business model was to take advantage of clients. That's the second paragraph on your bio on your website.
Yeah.
Expound more on it.
Well, first of all, I'll say our internal comms team made me tone that down. I usually like to say this is the industry publicly admitting that they're screwing 8 million of their clients. If that is their reasoning, is that, hey, we can't afford to both act in their best interests and service them at the same time, and yet here we are still sending them a bill every month or every quarter or every year, then what are you doing, right? But this gets back to, I think, the whole origin story, which is when we saw that, that was when the light bulb went off and they said, wow, this is a real need, because you have people that are opting into this, right? And the industry's done a very good job of sort of obfuscating what you're actually paying for and what you're actually getting. So, one of the most insane things to me is when we poll our clients or prospective clients, we say, how much do you think you're paying your current advisor? A lot of them say, I don't pay my advisor anything. And it's like, how do you think these folks are making money? It's a huge, and look, I think I will temper this a little bit by saying that it's easy to sort of, throw stones at the industry. I think that there are a lot of individual advisors who are in this for the right reasons. Yeah. But the way that the incentives are just structured, and also sort of how the norms have been established, they're all benefiting off of sort of industry pricing structures that started decades ago.
Yeah, and I would agree with that. I think I've met a lot of really great advisors, and I bumped into some ones that I think should be ran out of the industry. Everybody knows those. I do think the average individual advisor is in it for the right reasons, but the legacy of our industry, maybe the pedigree, is packaging products and selling them,
Yep.
right? It was access to the stock market. Then it became, kind of confounded or correlated with insurance and then mutual funds, and then, away we went.
Yeah.
The large firm that I started my career at, when I got into fee-based financial planning, I was one of maybe, several hundred advisors that was there. And they're a great firm, so I'm not meaning anything derogatory about it, but they had to take this position that while we were engaged in fee-based planning with a client, we were acting as a fiduciary. Mm-hmm. And then when we delivered their plan and the client signed off on it, we could then go back to selling, and our relationship would magically transition back to a broker-dealer relationship.
Yeah.
Right? And I think part of the reason was they had proprietary products, and they were, like, let's say they were really good products. Mm-hmm. They are. But I had to somehow tell myself, and this is when the light bulb went off for me when I got into fee-based planning. I had a large prospect that said, unless you can give me an invoice and a list of your services and I can write you a check, don't ever call on me again. And it was like, well, I can't do that. So I figured out how to do it. But anyway, this idea that you could be a fiduciary and then stop being a fiduciary and then be a fiduciary and then stop, it would be like me saying I can be a dad today and then tomorrow I don't.
Yeah. Yeah, no, it's a real issue. So let's deconstruct what's actually going on. Yeah. So this whole industry has come about basically because of an information asymmetry, right? Okay. And so I think, if you think about like the very beginnings of the stockbroker, right? You had someone call up and say, hey, I've got a really hot tip for you, buy this stock. They were, worked on Wall Street and they had better information. And so, they could give you a hot tip. Sometimes you made money, sometimes you didn't, whatever, but you got a commission and you were willing to pay for that access to information. Then it became apparent that it's like, okay, well, that when you actually look at sort of the performance of that approach, like you're not, you're basically getting sold a stock, you're not buying a stock. And then you had sort of the evolution of mutual funds and ETFs and that sort of thing. And so you could have a much broader portfolio. The returns were generally better and more stable. Access to those products were still somewhat controlled. So you still had that information asymmetry. And so you had now advisors who are essentially saying, hey, I understand which funds to pick and I can get you a better return than if you try and do this yourself or work with someone else. And so again, you can still sort of justify the asset-based fee under that model. But now in the last, call it 15 years, the idea of the world of asset management, investment management is so commoditized, and with the exception of very few sort of like private funds and VC funds or PE funds, basically any investor can get access to any instrument, and the returns are largely the same. And when you sort of take the risk reward into into account, for 98% of investors out there, the answer is sticking in a low cost ETF, yeah. Right? Yeah. And so, no longer can you actually say with a straight face, I as an advisor am adding alpha to your portfolio. Yeah. Because if you have someone who's saying to you, hey, I can beat the market, you should run the other way as fast as you possibly can.
Agreed.
Right?
Agreed.
So the value prop has changed, but the way that they're pricing has not. And I think, and again, to kind of throw a bone to the broader advisor community, I think that folks are realizing more and more that financial planning is actually a value prop in and of itself, and that there is real value to it, and you can really help people a lot more with financial planning as opposed to trying to pick better stocks or better funds. I think it was Vanguard came out with the Advisor Alpha study, right, and the Morningstar Gamma study, right. I mean, working with a human, having a human holding you accountable, there is huge value in that.
Oh, absolutely.
But that's more of like a therapist relationship. It's not a stock picker relationship. And I think that the pricing mechanisms of the industry have not caught up to that. And I think it's going to be a while before they do, because the economic rents that people can charge are just so great. Why on earth would you give away a 60% gross margin AUM-based business model where you have 98% annual retention because the client doesn't see the money leaving the account, when instead it's moving to an hourly or annual subscription model where
they have to write a check for it or put it on their credit card.
You got to provide value every single time you bill them, right? It's harder work. So and arguably probably for less money. So it's you can see why we are where we are. But my longer term view is that the market always moves towards efficiency, and at some point this imbalance will work itself out.
Yeah, I agree with that. I think that the explosion of small RIAs, advisors leaving large firms, and a lot of them still run an AUM-based fee. And you know, back when I first started the podcast, one of my first guests was Marty Bicknell, the CEO of Mariner, and you know, he disagrees with me in terms of my viewpoint that the AUM-based fee is maybe going to fade out and it's going to be replaced by subscription, retainer, flat fees.
Yeah.
And I don't know whether he's going to be right or I'm going to be right. That's not the point. The idea, though, is the majority still do. So it's easier to explain to a client, I think, for a lot of advisors, whether they've been in the business a few years or a lot of years, is, well, this is just kind of how
this is how it is.
This is how it is,
Yeah.
right? Everybody does it. It's like going to the DMV, right? You
Yeah.
take a number, you stand in line, you wait till you're called. It is what it is. But it's an interesting thing, though, because we might be the only industry that we get paid more every year for doing the same amount of work.
Right.
Market goes up 17%. My business grows by maybe not 17, maybe 15%.
Yeah.
And I don't have to do any more work.
Well, that's I think the charitable view of that. I mean, the one that I always go back to is like, okay, so say that you're a client of an advisor, you do a great job at work, you get a $50,000 bonus. You should probably invest a chunk of that. Why should you pay your advisor an extra $500 a year because you worked your tail off last year? Doesn't make any sense.
Yeah. It certainly has challenges to it, and well, every business at some level could be argued that it has a conflict, whether it's a subscription-based one like yours and mine, or a flat fee or an AUM. Right? Our desire is still to turn the client or the prospect into a client and sell our services.
Sure.
This idea that by simply having an AUM fee that you can be a fiduciary, right, or that you're a fee-based planner. I did a training a couple of years back, and I asked a whole bunch of advisors, how many of you would consider yourself fee-based advisors? Like every hand in the room went up. Mm-hmm. I said, how many of you send an invoice to your client every month and they write you a check for it? Like looked around the room, there was two hands, like two hands up. I was like, that is truly maybe fee-based planning, like client signing up for X, Y, and Z, they're directly paying you for this and you have to deliver, and if you don't, they fire you. Right. So I think it's an interesting thing. So this feeds into the idea of one of the things that I think is a challenge in the industry, which is the business model. Mm-hmm. So driven in part by the asymmetry of information. I've talked about this before with guests, what I call the democratization of finance, right? Everybody with an iPad, smartphone, whatever, they actually can have access to the markets easier in some regards than advisors can, because there's no compliance oversight. Right. In some regards, they can trade equities, they can trade options, they can do cryptocurrencies, and advisors sometimes have their hands, rightly or wrongly so, that's maybe for a whole other conversation, tied up in regulation. But this democratization, this access that fintech and technology has provided to people, has moved so quickly, and the business model hasn't shifted. So when you guys were setting up Facet, let's talk a little bit about the business model, kind of problem the industry has. We've already been into a little bit. You guys decided to go into the subscription fee model. Tell us a little about how you guys have your business model set up for your clients. Do you guys charge monthly or annually, one time? Like how is your business model set up?
Yeah, so a couple kind of core tenets for our, for how we started the company. One was that, we believe in the value of the human relationship, and so everything that we thought about was, the real value in working with advisors, having that accountability partner, having that person who can sit there and kind of pick up the nuance in your situation and sort of help you navigate not just the technical aspects of financial planning, but also the emotional ones. And so we said, okay, how can we build a model that's profitable to just enable that human-to-human relationship and maximize the amount of time that our clients and our advisors spend together, basically minimize everything else. The technical aspects of financial planning are basically all automatable, and so that's what we did. So I'm telling you a little bit about our productivity model, but it all kind of blends together. Which is, the average advisor today works with about 75 clients. Ours work with between 250 and 300. And the way that we sort of have done that is, if you're spending an hour of client-facing time, you're probably spending about 3 hours of time
at least,
right, prepping or wrapping up from that meeting, and a lot more in the first year of the relationship when you're getting everything onboarded and kind of getting up to speed. So that 3 hours of prep and wrap up is very low value added human time. It's like going in a bunch of different systems. It's pulling reports. It's like mapping the data in Excel to make sure it all lines up. Again, this is all stuff that technology can solve. So kind of going back to my tech roots, we built a platform that essentially eliminates that 3 hours of non-client facing time and automates the vast majority of it. So, our advisors are prepping in 10 to 15 minutes for a client meeting. The quality, I would argue, has actually gone up because they can spend a lot more time covering a much
The things
broader
that clients
spectrum.
actually care about.
Exactly.
Yeah.
Exactly. So, and this is where technology is deflationary, right? Like you can, over time, you have higher quality and lower cost, and it's just this beautiful kind of positive sum effect. So, that's essentially what we did. And then we said, okay, well, given sort of how our supply side is going to look, let's figure out how we price it so that it's accessible to more clients, it's accessible to a broader market. And then let's think about how we price it so that it's totally transparent and totally we're on the same side as the conflict free. Yeah. And so that's how we arrived at the subscription model. And basically we have an algorithm. When we onboard a client, we look at sort of all the different things we're going to be doing for them. We have a two-step or a two-call sales and onboarding process where we gather a bunch of data about the client ahead of time. And so we have a very good sense of, okay, here's how much.
This is before they've signed up. So you guys are doing
Correct.
some kind of pre-work discovery that's leading to what some people might kind of call like the offer or the client engagement letter or something like this.
Exactly. Okay. Yep. And so in the first two calls, they meet with one of our client success managers who are typically not CFPs.
Yep.
And then basically based on what we find out about them, we number one, come up with the right price. To give you a sense, our average client pays us $2,600 a year.
Okay.
So and we've sort of run the numbers on that, and if they went to a sort of traditional advisor like a big shop, they'd probably be closer to $6,000 or $7,000 a year, if they could even more. Because we have a lot of clients. We only manage money for 50% of our clients.
We'll get into that. I want to get into that one
for sure
in detail. Yeah.
And actually, while we're on this topic, 75% of our clients have never worked with a financial advisor before.
Really?
Yeah.
So you're not finding that you guys are building clients by I'm going to say stealing. That's not the right word. By transitioning them or providing them a better option than the advisor they're at now. You guys are truly finding people that have never worked with an advisor. That's fascinating.
Exactly. Well, go back to our whole origin story around, there's 38 million households out there. And, it seems like only 8 million or so actually work with an advisor today.
Yeah, I've seen that number around too. Something like that, 8 to 10 million.
Yeah. So funny enough, matches up exactly with the the industry pushback on the DOL rule, right? But in any event, so we give them the price, but then we also basically figure out, okay, who are we going to match them to from an advisor standpoint?
Got it.
Because we have clients that are going through a divorce, and we have advisors who specialize in that, or we have clients that are starting a family, starting a family, ending a family, right? And so we we have advisors who specialize in that. So we try and match the sort of client need with the advisor skill set, at least from a personality standpoint.
Yeah. I think that's interesting. As I talk to individual advisors and even small firms, one of the things that seems clear to me, and it just could be my bias, is that to survive in the future, if an advisor has kind of what I'll call a lifestyle practice, they need to get really, really niche.
Yeah.
Right? Because what you're describing to me is you guys are essentially saying we have a big enough kind of stable of advisors, right? Men, women, backgrounds, different specialties, et cetera, that you can align that client with somebody that's really close to them in terms of the work they're doing. And the individual advisory practice, the traditional advisory practice, which is, kind of bring on everybody who just has a certain income threshold or asset-based threshold. Eventually you wind up with engineers and business owners and a doctor or two, and there's really no way to connect all of them.
Yeah, we're a bit of a unique animal because we have 135 CFPs right now, so it's we have that sort of scale.
What's the average age of your advisor? This is a PS, just curious.
That is a good question. I think
if you had to guess,
I'd probably say late 30s or early 40s.
Wow.
Yeah.
Okay. So you guys are a unique animal. The average age of an advisor in the industry is what, 58?
Yeah.
60?
Yeah. And we have some of those, right? I mean, we in general, I think the types of advisors who work well with us are like folks that are coming out of like a call center environment, answering an 800 number, something like that. Like not as much sort of independent advisors who've run a lifestyle business before. We're different, different work style than that. But if I could kind of give you an analogy that I've used, which is that if you sort of map where we are to like the healthcare industry, right? Okay, so just bear with me for a minute. Okay. So think about like, the Wild West in the 1800s. You had like the snake oil salesman, selling the
Grandma's
magical
elixir.
Exactly, that was just the elixir. And I would say that was the stockbrokers in the 70s and 80s. Okay. And then you have where I think we are now is sort of like the village doctor phase, where, this is what, maybe 40s, 50s, where you basically are differentiated by geography and relationships. Yeah. And so you've got someone who's sitting in a small town who, is a known entity, and everyone within 30 miles of them is their patient. And I would say that's largely how advisors differentiate right now. Yeah. You think about, pick your small town in the USA. You've got a set of advisors who are sort of like the pillars of their community. They develop business primarily through referrals from existing clients, or by doing things like, sponsoring the local
charity events, golf outings, school boosters.
Right. I would argue that is not a differentiator, and I would think when you're working in a commoditized world, which we've already established as asset management is, the way that you sell is through relationships. So this all follows, like the only way you differentiate is through relationships. So this all makes a ton of sense. But I think you hit the nail on the head. The world that we're moving to is around specialization. And if you think about what the healthcare industry looks like today, you might go to New York to see a specialist for, whatever ailment or, it is that you have. Or if you have like a certain type of surgery that you need to have, there might be a doctor, in Minnesota who's the best person to go and see that. And we live in a world now where you can do that, right? Like you don't actually need to sit down face to face with your advisor. Yeah. Like I would much rather have a video call with my advisor and talk about, the highly specialized planning that I need, instead of like, I can get in my car and drive down the street and then I got to deal with parking and like getting my parking ticket validated and all that. Like there's a lot of like, sort of legacy stuff that's still out there that I think fast forward a few years from now, it's going to disappear.
Yeah, we moved our office out of Grand Rapids is not nearly the size of San Francisco where we're sitting here for this interview. We moved our office out of the kind of the downtown corridor because clients were saying, finding a parking spot can be challenging. And we were looking at, just the costs of having, kind of, let's say, high rent, office district, paying for parking, things like this. And we're like, that actually doesn't add any value to our clients.
Yeah.
Right. So we moved out to the suburbs, have a nice office, parking's free, it's easy for people to find us. But this idea of the village, doctor is one that I find interesting, because what also happens in our industry right now, right, is you have this conflation of titles. You can have somebody at a large insurance firm that calls himself a wealth management advisor, and you could run into somebody at a large wirehouse that calls himself that. They all might say they do financial planning, or they're all doing advising, yet they could be selling products or gathering assets, or truly maybe more, shaking hands and kissing babies and being seen in the community, right? Yeah. And I don't mean anything, no disrespect to any of those, because I don't think you do either, but it's kind of this generalist idea.
Yeah.
And yet everything else in the world is rushing or has already arrived at specialization. The healthcare industry one is a great one. I wouldn't want to go see my family doctor if I had a hole in my heart.
Yeah.
And I needed heart surgery.
Yeah.
Right? I'd say, who is the best damn, thoracic surgeon or cardiac surgeon? And I want to go see that person.
Totally.
Right? And I think we're starting to see this more, but it's still running into this idea of the village doctor. I like that analogy.
And part of it, and this is a third rail that I certainly don't want to step on, but there isn't really like one professional standard, right? And I know that there's
absolutely
all sorts of bickering between various organizations around what it should be. Yeah. But that is part of the problem. Yeah. And so I think until that gets established, it's going to be a while before that happens.
And I don't think there's anything wrong with a sales business model, right? I actually think that the work that, I own a bunch of insurance, both personal insurance and work insurance and health benefit. Like, there's a valid reason to have a distribution model where people are paid a commission and it's product based. That's great. We should just, though, try and get the industry to agree on, let's make sure the titles are clear to the client.
Yeah.
So the client doesn't think they're getting the cardiac surgeon when they're getting the village, doctor, right?
Totally. And also, like, there's a disintermediation between the person who's doing your planning and the person who's selling you stuff, right? So like this is one we run into all the time where we help our clients with insurance. So first of all, actually, let me back up, which is, I talked about our sales and onboarding process.
Oh, let's get back to that.
Yeah, but so we don't comp our planners on sales at all, right? So none of our planners are expected to develop business to sell a client or to sell a product. And that's, I think, a super important part of our sort of like conflict-free model. But there are all sorts of things where the right answer for the client is you need some sort of financial product or additional service like estate planning, and so and insurance is my favorite one because it's illegal to not take a commission.
Correct. Yeah, right? The products themselves have to have it built into the contract.
Yeah,
and if you don't, it's some form of rebating or absolutely. We've run into this one too.
Yeah, so we donate all those commissions to financial literacy programs.
Interesting.
Yeah, because we say, hey, like we can definitely get you best execution on this.
Yeah.
But rather than you think that we're taking money on the side, like hey, here we're sponsoring a school in Baltimore to with a financial literacy program. So that's how we kind of work our way around that one. But I think that there's a disintermediation in general where I think you can have someone who they are paid to be the planner and they are paid to be the fiduciary. Yep. They might recommend a product and I think it's also totally fair game to say, hey, you know what? We have 3 or 4 preferred providers who we've vetted and they are fiduciary products. Yep. We can get it with our fiduciary lens. We can recommend these products. Yep. And you can choose which one you want, but I'm not going to make any money off of it. And I think, and the person who's selling one of those products, like they should, however that business model set up, they want to make a commission off of that. Again, I don't disagree with that, but I think that you can disintermediate the two roles. Yeah. And I think that's going to be super important.
Yeah, and if you don't, all roads lead to buying a product or bringing in assets, right? And that's, I think, back to my first point about I see 2 business models that are brother and sister, giving away advice to sell a product, giving away advice to gather assets. I think they should be broken apart. And there's a book called Measure What Matters by John Doerr.
Oh yeah, the OKR framework.
Our team follows it. Yeah. Something that across kind of connection is one of my favorite books is Essentialism by Greg McKeown, and he has a quote in there. I think it's from John Maxwell that goes something like, very few things in this world are exceptionally valuable. In fact, most things are not valuable. And what I find interesting is our industry tends to reward people who are the best salespeople.
Yeah.
In the current model, right? You're breaking this framework up, so your advisors are not paid a higher commission or bonus or payout structure by bringing in new clients. Their job is to be really, if I'm hearing you right, your business model is, hey, Mr. or Mrs. like CFP, like your job is to be an amazing fiduciary advisor for the client.
Yeah.
Let Facet go out to market, bring in clients, you do this. So how do you comp and reward? You don't have to get into specifics, but as we talk about that, I think one of the things I hear from firm owners is that if there's not some type of compensation tied to bringing in new clients, and that advisor might not ever become profitable and pay for themselves, right? There's a massive issue out there in the industry around like client acquisition and development. But how do you have your system structured then to incentivize or to measure what matters, then monetize what matters for that advisory role?
So from an advisor standpoint, we pay them a salary, a flat salary, and a bonus tied to basically client satisfaction, retention, and referrals. And we're not asking them to develop business, but if someone refers a client, that's a very happy client, right? Yeah. And then, from a sort of like, measuring what matters, we look at one of the great benefits of this industry is the longevity of the client relationships. Yeah. And so, there's this crazy stat that like, I think the average annual retention is like 97%. And yet the NPS and Net Promoter Score average for the industry is like 30. Yeah, it's got 34, but yeah. There's this like wildly interesting dynamic where you basically have like miserable clients who never leave, right? Which by the way is like the key. That is the most fertile ground to start a disruptive company in. But anyways, so we look at it from we can count on a long client lifetime with us. We don't factor in 97% annual retention, but in the 90s, right? So we say, hey, we're going to have a client for at least 10, if not more years, and we can look at the sort of the long-term gross margin streams that we're going to be getting from those clients, and we're okay to pay more upfront in sales cost, knowing that we're going to have that client for a long time. So this is a kind of classic SaaS metric of LTV to CAC ratio. And we're very confident. We've been around for 6 years at this point. We're very confident in sort of the client longevity, our gross margin.
You're seeing your numbers that you started projecting back when you set your firm up actually playing out.
Yeah, exactly. But we're thinking about, okay, what's the with every dollar that we spend in client acquisition, we get like $11 back in the long run, and so we're very comfortable to we'll turn that crank all day long.
Yeah.
It's different. It's a very different model than most advisors because we're burning cash, right? And you mentioned in the beginning we've raised a ton of venture capital.
Yeah.
We will raise more, and so we burn a lot of cash. So we're not focused on what's our advisor take-home pay? How can every single person in the firm make $400,000 this year?
Yeah.
That's not it. It's the value in the long term is in the equity.
Yeah.
And so so again, it's a totally different model, and we're okay to go negative on a absolute profitability basis for a long time.
Yeah.
In order to achieve that.
Yeah, and I think that's this is your background was in technology and venture capital and stuff. Mine wasn't, but one of the things that I've seen about this space is because of the long-term annual recurring revenue, right? It's very similar to a SaaS model business. Mm-hmm. Advisors and firms, if they studied those businesses, could wrap their heads around acquiring clients and paying more for clients or being more aggressive. In fact, I'd love to see more firms come out there and even start up RIAs and raise capital to go out there and acquire client bases, whether it's organic marketing or buying practices, because I just look at it, I think the math is, if you treat the clients well, mm-hmm. right, the math is pretty powerful. It's a really profitable business, right? You just have to get out of the idea of, he who brings in the clients should take home half of the revenue. That's a terrible business model. Agreed. Right? Because you don't have any margin to invest and to pay things back and to hire the right staff, right?
And I mean, once again, it's a conflict. It doesn't align. The value that a client receives is not from who sells them, right? It's from who services them over the long run. Yeah. I do think we're going to see a lot more consolidation in this market. Right. I mean, I think just in general, it's like 30,000 RIAs out there, and the largest, the retail facing firm with the firm with the largest sort of wealth management market share is Fidelity's retail business, and they have like 10%. And so there's room for another Fidelity sized company out there, and between the two of them, there'd still be 80% of the market, and that I just. Over time, there has to be consolidation. Going back to the healthcare market, very few independent village doctors out there these days, right?
They've all been gobbled up by large medical practices, hospital groups, or insurance companies.
Yeah. Exactly. And I think, it's interesting, sort of pre-pandemic, people were talking a lot about, there's going to be the regional and the super regional RIAs. I think post-pandemic, geography is not going to matter at all, right? It's going to be totally different. It's a very, very different value problem.
Yeah, I mean, I count it just an absolute privilege to get to have interviewed some great people in the space, you included, and get a sense of, that same understanding of the opportunity that exists out there. I had somebody once ask me, well, aren't you, kind of afraid that you're interviewing your competitors and blah, blah. I'm like, look, whatever number, whether we say it's a $50 trillion industry or $60 trillion of retail assets, I've seen a lot of different numbers. The largest RIA out there is maybe 250 billion of assets, ish, maybe. If you
thinking like CapTrust, Edelman.
Yeah, something like this, right? And if you were to ask, 100 people on the street if they had ever heard of one of the largest RIAs in the country, the likelihood is none of them would.
Yeah.
Right? And so even if all of the largest RIAs in our space all got to $1 trillion of assets in the next 5 years, they'd still only add up to maybe 10% of the industry.
Yeah.
Right?
Yeah.
And I think the ideas that I'm seeing out there, I mean, you see the big guys, CapTrust, Mariner, places like this, doing these acquisitions and roll-ups, and I'm sure the math behind it makes a ton of sense, right? There's definitely a reason for it. and you see this, I think, in the fintech and the wealth tech space, right? Where large insurance companies are buying technology companies, most often with terrible outcomes and results. It's another conversation. But this kind of, trying to find ways of adding incremental value or growing, I think of, happening, right? And they're going to keep happening at speed.
Yeah.
Right, which might make it easier for somebody that's an advisor that wants to have a niche lifestyle practice. I actually think it's going to make that easier, but they have to be niche, right? Because they can't be a generalist anymore, because a generalist can, the consumer can go online, or they can go to a national-based RIA like you guys or like Lifeworks, where, we can take care of them really, really well and align them with specialists.
Yeah. Right. I'd say I'm short billion-dollar RIAs. Like, I think that there's going to be a lot of $100 million RIAs.
Agreed.
And I think there's going to be a lot of, tens to hundreds of billions of dollars RIAs. Yeah. And I think that in-between space is going to be, Yeah,
I had a friend call me. He's a partner in what I would consider to be a large RIA, but, the industry would consider it small. I think they manage like 600 million of assets. He's in Michigan. And when he saw the PR release about Mariner acquiring Advice Period, and there being some partnership there with those two guys, he's like, should I even be trying to grow my business and like hire advisors and build a business, or should I just? And I said, well, I think you got to get really clear on what you want. Yeah. Right? Do you want to have 100 to 200 clients that you know intimately, and you have a fantastic income from it? Arguably, like maybe we're overpaid in this regard, or do you want to try and go out there and like build equity value? And then, yes, you're going to probably have a little bit of a harder run at it unless you find some specialization or technology that you're going to add to your piece. And he just kind of like, said, well, I'm not going to do either. I'm like, okay.
You're going to be stuck.
Yeah. Right. So I think there's some agreement there. So let's talk a little bit about you came from technology and venture capital. That was your background before you got into wealth management. You started building the technology as soon as you built the RIA, or did you build some of the technology platform and then open the RIA? Just talk to us a little bit about the way that you view investing in technology, right? And
as an operator.
Yeah, maybe as an operator. Maybe this is a little bit of the chicken and egg thing, right?
Yeah.
We built the RIA and then realized there wasn't the technology, and so started the joyful process of building technology.
Yeah.
How did you guys come about that, and where does technology sit when you're thinking about, investments, CapEx, both as an operator and kind of growing it?
Yeah, for sure. This could be its own podcast, but so the short answer is it was all concurrent. So one of our other co-founders, Brent Weiss, was a partner at actually very similar to your friend, right? At a several $100 million RIA, and he was the one. And by the way, back to our origin story, you mentioned the mother thing. Yeah. We call it a tale of three mothers, right? So there's my mom at Fidelity. There was Brent's mom, who he as a partner in this wealth management firm couldn't actually provide service to her because she didn't have enough. Yeah, and then our third co-founder, Patrick, his mom was a mailman, and she delivered mail for her whole career. She had $350,000 or something like that saved, retired, went to Edward Jones, and they tried to sell her on an annuity. And fortunately, she called him, and he talked her out of it. But that was like that was the mother trifecta. Yeah. But in any event, so when Brent and I first met, and I sort of described what I saw was this macro problem, he said, "You have no idea." He said, "I have sat down and timed how much time it takes for me to do certain things and to service clients. Like, it just doesn't make any sense." Yeah. And he comes from the wealth management world, so he had no technology background. Yeah. And so we had two other technical co-founders, and we basically the first 6 months literally just sat in a room and watched him work.
And just saw the problem after problem after problem.
Yeah. Yeah. And so we had 25 beta clients that we brought in. We didn't charge them anything. And did financial planning for them, and he went through and basically did his whole process. And so we said, okay, well, this spreadsheet, here's where duplicate data entry is happening and that sort of thing. And so, we literally sat there with a stopwatch and timed the whole thing. And then from there, we were able to kind of build the theoretical financial model. Yeah. And then, figure out, okay, where's the sort of highest and best, so the next dollar investment for technology, what's the biggest thing that we can sort of knock out? Yeah. And so, I think to to your point, like you guys did it the right way too, which is that you have to start with a process and then you build the technology around it. And I think one of the bigger problems in the wealth tech space right now is that you have a lot of companies that are selling sort of one-size-fits-all technology when you have advisors who have disparate processes all over the place.
And then advisors wound up, and this is not to interrupt you, this was where my head ran into the wall. And when I left a big firm, I thought, I'll get to pick my technology, we'll have this amazing client process, and next thing you know, it was like, well, we need this technology to service these clients and some of this technology to service these clients, and then we got to get this other technology to connect the technologies. And next thing we knew, it was like, we have 15 different software things, and people were like, well, tell me about your software stack. And it's like, I hate that. Like, the idea, I want to have a system that runs my business, right? And so I agree with you. I think there's lots of technology out there. In fact, Kitsis has this map of technology providers. I call it this maze. And none of them probably fit any one client or any one advisor or firm perfectly. So then they get kind of amalgamated with other ones. And so.
I actually wrote an op-ed about this for Investment News a couple years ago. That was basically exactly what you're saying, which is like, a wealth advisor or a financial advisor is not a CTO, right? They're not a sophisticated tech buyer. And so you have this term in Silicon Valley, which is like, this is a feature masquerading as a product, masquerading as a company. And there's a lot of those out there. So I think, again, sort of medium to long-term prediction is there's going to be a huge consolidation in the wealth tech space.
There has to be.
There has to, and VC investing in that space has actually gone down quite a bit. Against a backdrop of like huge increases in VC investing basically everywhere else. So I think that's interesting.
So you said it's a feature masquerading as a product, masquerading as
a company.
All right, I'm gonna hang on to that one.
Yeah, and I'll leave it up to you to decide which which companies qualify there. But I do think that there's I do think actually that there is a role to play. I mean, the one of the bigger issues in that space is distribution costs are too high, right? So even if you could get the perfect product, the cost of actually selling to advisors is too high. And going back to the LTV to CAC metric, that's upside down in a lot of these cases. And I think the biggest evidence is, the largest company that has sort of succeeded in this space is Envestnet, arguably, maybe Orion, but I think Envestnet as a public comp. And they have a $3.5 billion market cap. So like, if that's as big as you can get, that's not like a VC investable space. Now, I do think that here's another crazy long-term prediction: the custodians will eventually become technology companies.
Yes.
Because I think they are the only ones who actually have the distribution pipes. Because every advisor that manages money needs one. And their asset-based businesses are really hurting right now, and I think are over time, will be less and less of a revenue, certainly of a profit stream. And they also have the sort of broad view of the landscape of all the different financial planning processes, all the different asset allocation models. Like, they have all the data. I think the problem is they're all really big companies that are slow-moving and that sort of thing, but. We work with Apex as an example, and I think Apex is getting it right. I mean, they put themselves out there primarily as a SaaS company and not as an asset, as a traditional custodian. And I think that's going to be the model of the future.
Yeah, I would agree. We're actively moving to Apex with the software platform that we're building. We're connected to TD and Schwab, but no offense to TD and Schwab, but when I can't click a button and open an account, and I can as a consumer on 1,000 different platforms. Right. I think you're right. Custodians have to eventually become technology companies. Right. In the days of paper books and records and T+3. Well, Bill Capuzzi, the CEO of Apex, was on the podcast a few months back, and he was talking about how the industry patted themselves on the back for going from like T+3 to T2 settlement. And he's like, it's because the records are so terrible and there's no industry-wide standard, right? And as we've been building our technology to these custodial platforms and looking at their data structures, it's just scary. But there's an evolution. Again, there's a lot of opportunity there for somebody to do it. And I would agree with you. Like Envestnet, $3.5 billion market cap. Orion, I mean, they're still privately held, so who knows what the value of that with Brinker and some of the stuff they're doing. But yeah, I think we're going to keep seeing the large tech companies try and buy some of the new innovative ones and roll it into their feature set.
Yeah, and I think, look, the flip side of all this is that I think one of the things we're seeing, like if you look at sort of fintech funding and valuations over the last few quarters, I think what we're seeing is that the markets for these new technologies and new way of doing things are a lot deeper than what people 3 or 4 years ago thought they were. And when you actually look at the sum total of antiquated technology, whether it's back office, middle office, front office, client facing, advisor facing, whatever, like there's so much work that needs to be done, and there's so much just to get people up to where we are today, let alone where, what's going to be possible in 5 or 10 years. I don't mean to say, I feel like I've been knocking a lot of things in our conversation, but I will say I'm very long fintech.
Yeah, no, I don't. I mean, I hope other people listening don't take it that way, because I take it when I'm listening to these things, and even when we saw our terrible technology stack, and I say terrible because it was supposed to be all the best technologies, right? And they each do a great thing, but when I realized that the problem that we had there, and I'm like, we're a startup RIA, like if we're having this problem, like what's a RIA that's been in business for 5 years, 10 years, 15, 20, you know what I mean? And I see them as opportunities, right? Whenever I see something that's either not working or has massive room for improvement, in my mind, it's just like, we can knock that because we need to be knocking that.
Yeah.
Because we can do better.
It's I mean, where we see problems, lies enormous opportunity, right? And as we've established, it's a big enough market that a lot of us can attack it at the same time from a lot of different angles. And
yeah. So it probably is a good segue to talk about your view of the future of advice. But before we go there, I know your firm is unique and how you came into it's unique, and that we were talking about how you view investing. I want to wrap this one back up because I want to get your thoughts on how you view investing in technology, and maybe even how you think about, do you consider yourself more of a technology company or more of a wealth management firm or some unique, Anders Jones definition of a hybrid? Because as you're looking at the venture capital you've raised and saying, okay, we've got capital deployed, we're burning cash, how are you guys deciding in how much is going into people and advisors, let's say, marketing for client acquisition versus building and developing your own technology? And I know there's more buckets than those three, but let's just tackle those three for this conversation.
Yeah.
Let's close the loop on that, because I think I asked the question and we got...
Yeah.
Okay.
So I think that, first of all, we're a technology company.
Okay.
And I think that there's an important sort of nuance to that, which I think people sometimes think like, technology companies, software engineers, that sort of thing. But there's a DNA around sort of building a fast-growing startup or sort of disruptive company around speed and iteration and challenging the status quo that we possess, that I think most wealth management firms do not. And so I'd say we're a technology company, but we're a startup above more than anything else. And so we grew. These numbers are public, but we ended 2019 with around $2.5 million of revenue. We ended 2020 with 10. We'll be somewhere in the 30 range at the end of 2021. So 4x and 3x.
Yep.
And we'll be well above that, obviously, in the coming years. And so that type of high growth environment, we're sitting here in San Francisco. You look around to some of the company, right? Like that takes a special type of person, and it takes a special type of kind of company mentality. It's very uncomfortable. Because you're basically reinventing yourself every 6 months. Not, our mission and our sort of core.
Your values stay the same.
Yeah, but your organization changes, every 6 months. Yeah. And we've our executive team has evolved, right? I mean, we're 6 years into it, and we've had a few iterations on our executive team. So there's, it's a very different kind of thing. So. Anyways, with that sort of context, when I think about tech investment, I think about, first of all, in terms of like, okay, there's sort of a couple different vectors that I look at. One is growth is incredibly important, right? The market values growth more than anything else, and there's also a reality where we are in a huge market. It's largely, it's fragmented enough that I'm not as worried about competition, but. Again, markets are efficient. the more successful we get, at some point someone's going to kind of come and try and copy us. The bigger we can get, the faster we can get, the more of a moat we have around that, and especially in financial services where brand is so important. So there's the growth bucket of investment. Then there's the sort of client above all else bucket of investment, and I think the two go hand in hand, right? I mean, the more that you can make your clients happy, the faster you're going to grow. And so with those things in mind, I kind of think about the next dollar that we spend. It's either going to growth or making the client or the client experience. And often, it's a little bit of a Venn diagram, so it's not a one or the other trade-off. And so, every month we get together and say, okay, here's all the different competing priorities that we have. So, I'll give you an example. Like this month, we're talking about, launching a client goal tracker, so clients can see, okay, every month or every quarter, here's the goals that I started out with Facet, and here's what I've done, and here's what's left, which obviously has a lot of implications for client satisfaction and just being able to kind of show our value on a real-time basis. We're doing some really cool stuff with Apex and our account opening, and there's like an infrastructure investment we want to make. There's some stuff we want to do for our planners to consolidate a lot of our tools in kind of in one area. That's a sort of team enablement investment. And so then we basically all sit down as an executive team and we kind of battle it out. And so I actually don't have an opinion on which one of those is the most important. You also look at relative effort, right? Like the client goal tracker one is relatively less effort than the Apex one. But then we have a very open prioritization discussion. And we also, and this gets back to the first point around kind of our startup DNA, we redo it every month. So we don't set a year-long roadmap. We don't set a quarterly roadmap. Every month we sit down and say, okay, here's what we think that we can do. And that's really rooted in this idea.
That's a really fast run.
Yeah. And sometimes we don't hit it, right? I mean, we picked 6 different things we wanted to do this month in July, and we got 4 of them done. And one of the things that is like a fun thing, our CTO actually, who comes from the software world, and this is his first foray into financial services, but he has this fun test where when someone starts, when he takes over a team or whatever, he says, okay, I want you all to estimate what you're going to do today, and then tomorrow morning we're going to come back and we're going to do it again. So it's like classic agile mentality, right? And it takes 6 weeks before someone can accurately estimate what they can do in a day. So for us, and that's one person knowing
themselves
and
seeing how wrong they are over time. So
you think about a 300-person company that is trying to estimate, we'll never get it right in a month, So anyways, that I think is actually probably more important than the decisions that we actually make, is the methodology of how we make the decisions, and most important is the speed with which we revisit them.
So tech company. And I think it's interesting because I would probably describe our company as morphing from wealth management into a tech company that does wealth management. Right? And which is a small nuance to it, but when you view the dollars, whether you've VC money or organic revenue that's being invested into building more of those things, I mean, they're being built to improve the client experience. Right? To do the work better. Faster, less expensive, things like that.
Yeah, and I think this is where you can be a wealth management company and still sort of subscribe to this idea and this sort of way of being, and still be incredibly effective. Like you don't have to be a technology. Technology makes everything easier. But I think that's it's a very, very important nuance. There's a great book which you might have read called The Hard Thing About Hard Things.
I don't think I've read that one.
It's
The Hard Thing About Hard Things. Who's the author?
Ben Horowitz of Andreessen Horowitz fame.
Okay.
And he has this great line in there that says, "There's no such thing as a silver bullet. There's only 1,000 lead bullets." And I've sort of added on to that. And the way that you succeed or your success is determined by how quickly you can fire those 1,000 lead bullets. It's a constant game of iteration, right? It's a constant game of iteration. But that's my number one book on entrepreneurship for sure.
Definitely, we'll have to read that.
Yeah.
Awesome. So that answered my question about kind of how you view investing in technology. I think the Venn diagram of those three buckets makes sense. Before we jump into getting you to pull out your crystal ball and picture the industry and talk about the name of the podcast, The Future of Advice, what are some of the big challenges that you see facing advisors and firms today? What are some of the other big challenges that you see sitting out there that for the people that are either advisors inside of a large firm, or maybe they own their own RIA, or they're an executive at a more established, larger firm? Like, what are some of the common challenges that you see?
So I will preface this by saying I don't spend a ton of time with advisors outside of Facet at this point. So it's hard to know, but I mean, some of the key themes that I've heard, I think, are, and these kind of ring true to a lot of the conversation we just had, like this sort of embarrassment of fintech choices or wealth tech choices. Right? There's too much choice out there, and there's a big mismatch between the level of sophistication of the average advisor who's trying to figure out what the best product is, and sort of like what it takes to actually put together a wealth tech stack. And so ironically, like those products are definitely being sold, right? Not
for sure, yes.
So so I guess it all comes full circle. But so that's one I think for sure. I think that there's this huge desire to work with the mass affluent market, right? I mean, for as long as I've been doing this, there's been this discussion around, the mass affluent market is where it's at. No one's figured out how to actually do it. And so I feel like there's a constraint around, where people are going to develop business. And, it's really, really crowded, above $1 million, $1 million and up. And so it gets harder and harder, and I think it's more cutthroat to develop business there. So yeah, I mean, that's definitely one of them. And I think also like, there's that great line, and this is getting a little into future predictions, but from the Sun Also Rises, which one of the characters asked him, like, how did you go broke? And he said, very gradually and then very suddenly.
Yeah, I've heard that before.
And I think that there's something to be said for. I think all of this is going to come together quickly, and I think over time, you're going to have people who say, I don't want to pay an asset-based fee anymore. I need financial planning. I don't have $1 million. I still want help. Your website or your client portal sucks. I don't have money for you to manage, right? Like all these things, and then you're going to have also like massive consolidation. And so I think like in the next 5 years, like this is all going to come to a head. And I think there's going to be a lot of shaking out.
Yeah. No, that's awesome. So this is a perfect segue then to talk about the future of financial advice, right? So you've laid a big one out there that I think, I might even just ask you to keep expounding on this one. But where do you see both the industry and the relevancy of an advisor being? Well, let's make those two separate things because those are different. Where do you see the industry being?
Well, let's start with the advisor.
Okay, start with the advisor.
Yeah, because I think this is a good like bottoms up thing, right? Which is like, let's go back to first principles of why do people work with an advisor? Like it's because you have the human interaction, you build a relationship, you rely on their expertise, you want someone to hold you accountable, you want someone to kind of share in your journey, you want someone to tell you like, hey, it's going to be okay, or like, hey, I'm giving you permission to do this, right? It's amazing. I mean, you've probably experienced this too, right? It's
when you're getting ready to make the largest decision of your life, you want to look somebody in the eye, even if it's over a Zoom call.
Yeah.
And you want to have somebody else there when you make the decision.
Yeah.
Right?
Exactly.
That's it. I mean, most of my clients, I always, when we look at it, they're bright, savvy, sophisticated. Either they've owned businesses, they've been executives, they've been engineers. It's not for lack of knowledge and sophistication and ability. It's truly just they're smart enough to recognize that these big decisions should have some outside voice to them. Right?
Yeah.
There's wisdom there, I guess, is what I would say most of our clients recognize.
Yeah, totally. And it's also interesting, it's like there's no real benchmarking for your financial life, right? You can't be, like, I don't know how old you are, but someone in your age.
Almost 40.
Okay. But like people in their, mid to late 30s, look very different, right? And so there's no real way to say like, okay, well, I'm 38, I should
have this much here and I should have this much in retirement.
Yeah, exactly, right? Because you also have 4 kids, right? I'm roughly in your age, and I have no kids. I'm not married, right? So like my life should be very different. My life is very different, and so so there isn't any one sort of like place you can go to get a DIY answer that says like, okay, well, here's where I fall in this benchmark, so I should be, I should be fine. Like you have to have that that face-to-face, the trust relationship. So if we're in agreement that that's where an advisor's value lies, and I think more and more people are going to realize that over time, and I think that consumers are getting smarter about this. Like if I had to take a bet, like a huge macro bet, like I would always take the side of the consumer will know more and understand more tomorrow than they do today. Yeah. And so you have to take that into account. And so I think people are just going to be looking for, for the real sort of root value of working an advisor. And, the advisors that are set up to deal with that, both from here's how I structure my time with a client, here are the things that I talk to a client about, here's how I charge the client, and also here's how I acquire clients. Because you actually want to be acquiring clients in the context of these bigger life questions, not in the context of retirement planning.
Correct.
Right?
or returns.
Or returns.
I mean, I talk to probably more advisors than you do, just because of how I'm going into the industry. And I'm still amazed at how many of them set their value prop on comparing their portfolio to somebody else's. And there could be some value there, right? But it's selling your value on returns is setting yourself up for absolutely getting your knees cut out up underneath you, right? I mean, it's just danger.
Total danger. Yeah. So the advisors that set their businesses up that way, I think, are going to be the ones that win. I also, I do think that, and it pains me to say it because I really like the independent advisor community, and I think that there's a lot of goodness in how the standard of advice has evolved over the last decade or so, and how like there are a lot of really good people in this industry, but I'm long-term fairly bearish on sort of the independent advisors, and so I think there will be consolidation there. I think it just makes sense from like a market structure standpoint. So if we're sitting at 30,000 RIAs today, I bet in 2030 there's fewer than 5,000.
Yeah. Well, in some regards, I think I would also agree with you. It has to, because unless that advisor is partnered with somebody who's doing, back office work, let's say, just to pick on something like portfolio management, trading, execution, clearing, an advisor shouldn't be positioning themselves to a client, in my mind, as being the person who's doing the investment research, doing the due diligence, building the portfolios, running the operations, managing their team, and, oh, by the way, still focusing on your plan. I mean, it's just impossible for one person to do that. And you have to get to a certain size and scale, or be willing to constrain your income and take the revenue from your firm and hire to those people.
Yeah.
Which I think for advisors who step back and look at it, if they want to build a business and they want to play the return on the equity side, great. There's lots of opportunities out there for it. I don't think most of them actually do. I think most of them want to play the cash flow maximization, right? The lifestyle practice game. Mm-hmm. And that one, my take would be, partner with people that can do the things and automate the things for you really, really well. And then find the one thing that you do amazing work for your clients and do that.
Yeah. Yeah. I mean, and there are models out there that are starting to pop up where you can actually outsource all the stuff, right? Like XYPN, I'm actually a big fan of theirs. They from a mission standpoint are very aligned with what we do. They have a very different way of getting there.
Correct.
Which is around enabling sort of individual advisors, but you can, some of their case studies are awesome, where you look at like, folks that have, that have like basically outsourced everything except their relationship management, which I think that's a good way of doing it.
Yeah. Agreed. All right, let's wrap up this conversation. You and I could probably go for hours longer on specific things. I always ask at the end of this a two-part question. And so here goes. Answer it how you want, but here's the first part of it. If you could give one piece of advice to a young, next-gen, hungry advisor, and let's say that's somebody who's a millennial and younger, young, next-gen, hungry, growth-oriented advisor, what would it be?
I would say go back to first principles of why you got into this industry and what you want to get out of it. Because listening to sort of the conventional wisdom is a very dangerous thing to do at this moment in time. I think that the conventional wisdom is peaked, and it's very much backward-looking, not forward-looking.
All right, that's awesome. Second part, what advice would you give the owner of firms, independent RIAs, small firms?
Same deal.
Okay.
But I mean, seriously, like, there has, and I can say this because we're not in the M&A game at all, but like there's, I think that there's never been a better time to think about selling your company.
I would agree. There's just the sheer number of great large RIAs that are out there paying very, very good valuations for businesses it's incredible.
Yeah. And who knows how much longer this market's going to run. 4 years ago we were sitting here saying the same thing, right? But at some point the music will stop, and so so we'll see how it goes.
And what are some of the big things that we should expect to see from Facet? Say the next 3 to 5 years, without giving away what's coming. What do you hope Facet looks like in 3 to 5 years?
I mean, we really want to be I call sort of a standalone generational company, right? Like if you look at sort of the disruption that happens in other industries, every 15 years, a company will come along and challenge a large incumbent and, either succeed or whatever. But the innovation will proceed apace. And I think for us, if you look at financial services, like who was the last true startup in this industry that
didn't, like, not a robo,
yeah, but like that is a meaningful standalone, like I'd argue Fidelity, right? Maybe BlackRock, they don't have a retail business, but or Schwab, right? I mean, we're talking about some behemoths that are all great companies, and and if Fidelity is public today, probably a multi-$100 billion market cap. But there hasn't been like a meaningful, I'll use the word challenger, to those businesses or business models in the last 4 or 5 decades. And so when I look at the opportunity that we have in front of us, I look at the way that we're solving the problem, I look at our product market fit and all of the metrics that I can see about how much our clients love us and how fast we're growing. I think we have the opportunity to be that next generational financial services company. And so, we're in this for the long haul. Like we've raised a lot of capital. Like you said, we'll raise more. It wouldn't shock me if there's an IPO on the horizon at some point. That
would be exciting.
Yeah, I mean, this is like we're really in this for the long run.
Yeah.
To bring this full circle to the first part of the conversation, this is a legacy thing for me. And so, as I say to my team, I hope this is the last job I ever have.
Yeah. No, that's awesome. I mean, I will continue to watch you guys and root for you guys' success. I think the more companies like yours that are started that challenge the status quo, that focus on serving clients and bringing technology in and building the technology to do this at speed and scale, I think is a necessary thing. So really excited. I love this conversation. I appreciate carving some time out of your schedule to be here.
Yeah, for sure.
And look forward to having you on the podcast and seeing how your prognostications about the industry, the 20 or 30,000 RAs down to 5,000 comes true, and some other questions. So thank you for being here. Hope you enjoyed it.
That was great.
Yeah.
Awesome. Thank you.
Awesome. And for our listeners, again, my name is Ron Bullis, the CEO and founder of Lifeworks Advisors. If you want to learn more about Facet Wealth, you can find them at facetwealth.com. You can also follow Anders on Twitter, which is @AndersJones. He's also on LinkedIn and some other social media platforms. If you are an advisor or you are in the industry and you want to get a sense about where it's going, I would say there's very few people in the industry that are a better indicator of where to be watching and to see the trajectory of what the industry is going to look like in the future than Facet Wealth. So until next time, I hope you enjoyed this episode of The Future of Advice.